Your RIN TV on-demand video will begin shortly. Meanwhile, be sure to register for RIN TV alerts by clicking on the link below.
The workers' compensation line of business, which is among the largest segments of the U.S. property casualty industry, has faced some uphill battles in recent years. However, senior financial analyst Gordon McLean says that there was some recent improvement in workers' comp based on the combined ratio, small as it may have been, and setting in the 117 range.
You have to go back quite a ways to the last soft market, the tail end of the last soft market, '01, to get a combined ratio that was that high prior to the current soft market. So that's all in companies that file an insurance expense exhibit with us that write workers' comp. But where we got that slight improvement in, as of year-end 2011, that was driven by increasing premium volume, which helped to reduce the expense ratios a bit, somewhat offset by increasing loss and loss adjustment expenses.
So while the industry is doing a bit better judging by the combined ratio, there are still issues that need to be dealt with. The challenges facing workers' comp include an environment where there have been consecutive rate decreases.
So with that, you had increasing expense ratios, and with the depressed rate environment, you had increasing loss and loss adjustment expense ratios. But going forward, what the industry continues to try to grapple with is the impact of ongoing medical severity inflation. I think when you break it down, you look at the frequency aspect. So over the long term, you have a general decline in claim frequency.
And that decline is due to a safer workplace environment, CFOs who are better managing their workers' comp, and manufacturing that has just gone by the boards. Just the same, for an expected payroll, there will be an expected set of losses.
There's some of that that can't be eliminated. Obviously, construction. Construction is something that it's not a job that's going to be offshored. It has to be done here, but you're going to have expected losses there. But if you look at the long-term trend, you see a declining frequency of losses. However, you have an increasing severity component, and that's due in part to increasing medical severity costs. Those differ on a state-by-state basis. And then you have some increased utilization.
Meaning more doctor's visits, which translates to more costs. Workers' comp by its nature is a long-tail line with a long-term investment float, and as everyone knows, this has been a difficult investment environment for insurers, forcing companies to focus on underwriting results. Now, workers' comp is a commercial line, and AM Best has maintained a negative outlook on the commercial line sector.
While we might maintain the negative outlook on the sector, that doesn't necessarily mean that there's going to be a rash of downgrades. Most ratings will be affirmations, but the negative outlook is an indicator that downgrades or negative outlooks will outnumber positive rating actions. But as I said, most rating actions within the sector are expected to be affirmations.
As McLean concludes, it's something AM Best will continue to keep a wary eye on.
I think the question is, where's the rate adequacy? And keep in mind, though, that just a couple of years of positive rate increases don't necessarily eliminate the negative aspect of 5-6 years of rate decreases.